Hello and welcome to Macro Money. This is Ilya Spivak, head of global macro at tastylive. And we've got what is the first in an absolutely massive week for fundamental and critical economic event risk. And probably the biggest one right up front, considering how important it has been for financial markets, really for the better part of 2 years. I am talking, of course, about the monetary policy announcement from the U.S. Central Bank, the Federal Reserve. What we're going to do here is we're going to talk about what's expected. We're going to talk about how it might actually turn out. We're going to talk about what the path might be after this meeting. And then most importantly, we are going to go through all of the key asset groups and see how important this might be and what might be the outcome. So strap in. We're going to go relatively quickly here, but there is, needless to say, a ton to cover because this is a huge, huge story. And we'll end with some very practical, very tradable kind of considerations where we'll look at what this means for stocks, for currencies, for commodities, and even for crypto. So let us begin. Let's first have us a look at what are the expectations. And the key thing here is we are looking at these numbers, every one of these numbers, relative to what is the current rate. Now, Fed moves rates in ranges. So the current target rate is 4.25 to 4.5%. The actual is the middle of that range at 4.33. So that's a single number we can use as a reference point. Let's look with that in mind at what we have baked in for this next meeting on the 1st of February. Note the second column over says percent priced in. 105, we'll round that off. And the implied rate change, next column over, is plus 0.26. What that's telling us is the markets have baked in 100% and some change of a rate hike. In other words, there is a very, very slight, just under 5% chance that they might go bigger than a 25 basis point or a 0.25% change. Very slight. But one rate hike is fully in the market at this point. So, with that, we then look at what is following on. The implied rate column is where I would direct your attention next. Here you can see that we're going from a rate of 4.59, so that would be that one rate hike that shifts us into the 4.5 to 4.75 range. As opposed to the 425 to 45 range where we are currently. And we move a bit higher through about mid-year. With the peak you can see there at June at 4.93. You can see that we actually get to 4.9, which is that next iteration, the 4.75 to 5% range, by May. So it looks as though we're going to have a hike now. We're going to have a hike again. You can see that the likelihood of one in March here is 82%. And you can see the priced in move, again, relative to now, is 4.66. So that's telling us that what we have here is essentially all of the rate hike for February baked in and most of the rate hike baked in for March. So almost 50 basis points. You'll see, though, that by May, the percentage is 44.3, and the full 50 basis points is there. In fact, there's a little bit more. So the takeaway here seems to be that we're going to get a 25 basis point hike right now over the next day. We're going to get another one at some point in March or May, with an 82% chance that it's in March and a 44-ish percent that it's in May, with a slight possibility, 7%, that it's in June. But overwhelmingly, the view in markets seems to be that what's going to happen is a 25 basis point hike now, another one in March, then a hold whereby May, June, we're in that 4.75 to 5% range. And from there, we start to head lower. From there, there is a hold and rate cuts come into the picture. So we slip under 4.75 by November. So you can start to see the likelihood of cuts being priced in there in the implied rate. We're back to 4.5% by the end of the year. And we are right back where we started by January of next year. So within a year's time, we essentially round right back to 4.3 on the implied rate, which is, of course, exactly where we are currently. If we look at a bit of a easier way to look at this, here's a yield curve, and you can see that here we have, again, starting at 4.3, we rise within a month, we're at 4.65, within 3 months, we're at 4.9, we hold there through mid-year, and then in a year's time, we're already on the way back down, essentially to where we are currently, so that within 2 years' time, we are now sub 4%, just a hair over 3. Within 3 years' time, we're sub 3. So that's the rate hike path that we're looking at currently. You can see that since the Fed last met, which was on December the 14th, looking at the way that this curve has shifted, giving the 14th for markets to kind of settle and digest. So from the 15th of December on to right now, this curve has basically been unchanged. There's been a bit of steepening toward the front of it, basically to suggest that the Fed is going to get to that 4.75 to 5% range faster. It's going to get there. You can see here at the 3-month level, before it was going to be closer to 6 months. The peak is still the same, so it seems like the Fed has built themselves a little bit of a wait and see period here between perhaps March and June, as we've just looked at on that table. And then with that in mind, from there, from the mid-year mark, we essentially have the same thing that we've expected since December. So the market's perception hasn't really changed. And let's take a look at why to kind of get a sense for what the moving parts are here. So first, we can clearly see inflation is doing what the Fed wants it to be doing. The orange line here is the 5-year break-even inflation rate. That's the priced-in expectation in bond markets. And as we look at this, we consider, okay, perhaps that's a little bit longer form, but if we look at the 2-year, it gives us essentially the same story. If we look longer at the more liquid 10-year, it gives us the same story. So looking at a kind of medium-term sort of thing that seems to be aligned with the Fed's mandate, which calls for a maximum employment with a context of price stability in the medium term type of mission, we seem to have inflation expectations marching lower. If we look at realized inflation, the mainstream indicator, CPI, Consumer Price Index, lagged just 3 months, seems to suggest that indeed the real economy is responding. We've added the core PCE, personal consumption expenditure indicator here, which is the Fed's favored measure of inflation. Core means it strips out volatile items like food and energy, which can obstruct the central trajectory of where this is going. If you look at that, you can see it doesn't even need a lag. It moves in line with expectations. In some sense, this highlights how focused the markets are on what the Fed is doing. Market expectations are being shaped, seemingly, or at least anecdotally, by where that core PCE number is going. And the real economy is just a tad lagged at 3 months. There's, of course, a bit of a reaction function there, but clearly you can see that Fed action has achieved at least the beginning of the trend that they want to have achieved. Now, of course, we know, because we are badgered by this endlessly, both in financial media and from people like myself and from the Fed itself, monetary policy works with long and variable lags. What this means is that all of the rate hikes that the Fed has done so far are not yet in the economy. They are working their way through. So there's still a tremendous amount of tightening that is yet to be absorbed. So it would make sense, as the Fed has told us back in December, to fine-tune a bit, to slow things down as the progress that we're seeing here has taken hold. It would make sense to then see what does the tightening still left here achieve as we move forward. Perhaps we have reached a point here where more tightening isn't necessary. Maybe the economic data will demand that more will be necessary. But we've certainly moved very close into a positive direction, and we're getting to an area here where the 5-year break-even is just a hair above 2%. So if we continue to see a bit of tightening come into this, maybe the Fed does have license to not add still more into the back of the funnel. But with that in mind, the conversation must necessarily go to what has been the cost of this success. And needless to say, the natural and screaming answer from economic data is growth, economic activity. This is a chart that we've looked at on Macro Money here quite a few times in recent days and weeks. This is the U.S. PMI indices. These are essentially indices of economic activity. So S&P Global goes out and surveys purchasing managers whose job it is at various firms to think ahead, essentially, because what they have to do is they have to know how many inputs they need so that they have the right amount of stuff to build their output for whatever it is they hope to ship in 6 months' time, 9 months' time. So they need to anticipate demand with quite a bit of a forward-looking view. They need to anticipate inventories to meet that demand. And so these are inherently forward-looking indicators. They operate on a logic where 50 represents expansion, or not expansion rather, but the difference between expansion and contraction, where above 50 is expansion, where below 50 is contraction. The farther you go above 50, the faster the expansion. The lower you go below 50, the faster the contraction. You can see here that For most of these indicators, somewhere in the second half of last year, we slipped into contraction territory. Perhaps most worryingly for the service sector and the composite, you can see manufacturing here a little bit on a different path here, at least as far as sequencing, but the composite, which takes manufacturing and services together, and the services component moving essentially in line, that's of course because services are overwhelmingly the biggest part of the economy. Manufacturing only perhaps about a quarter, services the rest. So what we're looking at here is economic activity in a forward-looking way, through a forward-looking lens, in contraction territory across the overwhelming majority of the economy. That, of course, comes at the cost of tightening. Then we might say, well, let's look at something more near term. We can see here that when we look at the way U.S. economic data has performed relative to expectations, even since the Fed's last meeting, I've marked December the 14th here, both in the reckoning of Citigroup and Bloomberg, both of which put together these indices, these surprise indices, which essentially measure how economic data performs against median forecasts, there's been deterioration. So the U.S. economy has done less well than economists have anticipated. Now, is that because economists have been overly optimistic? Well, clearly not. If we look at what's happened to GDP growth expectations, this is a survey of market watchers by Bloomberg, we can see here that GDP growth expectations for this year and next have not exactly looked very rosy. In particular, for next year, they've continued to decline. There's been a little bit of basing, seemingly, for expectations for this year, but hardly anything that would justify the tremendous upswell in risky assets that we've seen. So we get a picture here where not only have we had expectations get more dire in the face of these higher costs of financing that the Fed has used to engineer the cooling of inflation, but they've not been bad enough, these negative expectations, because again, when we look at how realized outcomes have actually performed, they've performed even worse. So whatever it is that led economists to think what's on this chart has not been a worldview that's been bad enough relative to the numbers that have come out, and that's notwithstanding the slightly better than expected fourth quarter GDP report that we got last week. It was, of course, better than expectations. It was slower than the previous quarter, but GDP data is notoriously lagged. Looking back at forward-looking data, things look rather meager as far as the state of the economy. And so we are facing a situation where, on the one hand, the markets have probably digested what the Fed is doing. They've probably understood Fed signaling because, again, the yield curve implied in rates hasn't really shifted since the last policy meeting, even as we've had a significant rally across a number of assets around this idea that the Fed is ready to hang it up, at least in the near term. So where does that leave this situation across various asset classes? This is a chart of correlations. Correlations work on a logic between -1 and 1. Almost never do you get perfect correlation, and correlation, of course, does not imply causation, so definitely recall that. what we have on this chart here are a slew of sectors and a slew of asset class groups that I've looked at here with a very narrow view, just since we've had this recovery in global shares and pullback in the dollar since, let's call it, early to mid-October and up through now. Take a look. The correlation here is based on the implied Fed funds futures rate path in the second half of this year. So through the part of that curve we just looked at, after the peak in rates and into the start of what could be the beginning of easing. So that part where we start to tilt back down and we end up by the end of this year, early next year, where we started here now before tomorrow's almost assured rate hike. So look at these correlations and how they've behaved. We have a tremendously positive correlation with the US dollar, 0.89. We have tremendous inverse correlations with risky assets, as well as assets that are inherently dependent on the Fed policy cycle. So precious metals, 0.87. Industrial metals, 0.87. Global shares. This is not just U.S. shares now. This is the MSCI Global Stock Index, or All Country World Index, ACWI. The tradable of that is the ACWI ETF. You can see there, again, negative 0.78. Very, very strong 60-day correlations, suggesting that we've really been talking about the same narrative in all of these assets since this recovery in risk sentiment has occurred. That we have a positive story, a positive correlation between this futures spread and the dollar, and of course we know the dollar has been falling, tells you exactly what's been going on. We've increasingly seen expectations for easing in the back half of this year, or at least a faster march toward easing, perhaps as soon as sometime in early next year, again, as we've just seen on the policy curve. And that we have a strong correlation there with the dollar, then of course makes sense. The dollar benefits when rates rise, that those higher yields make it more attractive. So on the flip side, we have negative correlations with stocks. We have negative correlations with industrial metals, which are inputs into economic growth. Stocks are, of course, also a creature of economic growth. Corporate earnings are a function of consumer spending. Consumer spending is a function of employment, confidence. Those things are, too, a function of economic growth. So all of the cyclical type of asset class groups inversely correlated with the deterioration in Fed policy expectations in the back half of this year, again, makes sense. Very much a mirror image of what we see with the dollar. If the dollar and rate expectations are going down, stocks, industrial metals are going up. For the precious metal space, the same thing. Precious metals don't yield anything, so when you get a decline in the rate structure, or at least the anticipated decline in the rate structure, those things look more attractive in relative terms. That the dollar has been falling against this backdrop is icing on the cake. The dollar is a yield-bearing form of money. Precious metals, most notably gold, are often looked at as alternatives to that, but of course they're not yield-bearing. So again, falling dollar, falling rate expectations, great news for precious metals, very strong inverse correlation there as well at 0.87. Things get a little bit weird with energy, because energy shows a high positive correlation, which means it's been falling with rate expectations, with the dollar. Now, given all of the geopolitics in the energy mix, needless to say, we can see that natural gas has been falling like a rock with seemingly no bottom, and crude oil has been completely unable to get itself off the mat no matter what's going on elsewhere in markets. It's not quite aggressively falling, but it's certainly idling without any sort of sense of real life behind it, even as other cyclical things move higher. So industrial metals pointedly here diverging from the story in energy. So in the absence of a clear fundamental explanation, it's the easiest in my mind to look at the war in Ukraine, to look at the warmer winter in Europe, and essentially say, well, the reason that this looks weird is probably geopolitical. It probably has to do with supply-demand considerations altering. There was a lot of concern, of course, that we were going to have a cold winter in Europe, that we were going to, because of the supply disruptions around this war, going to have a very difficult situation thereby. As winter progresses and temperatures don't drop aggressively, there's a natural repricing in markets. So as we move further and further towards spring, and temperatures don't make energy shortages an issue, we get the removal of that risk out of the energy market. And so it's been beaten to shreds, and clearly not really very responsive to this narrative. We'll see what happens when we get to the aftermath of the FOMC announcement and see if perhaps that changes. The other somewhat strange character here is Bitcoin. And we're using BTC CME futures here as a kind of stand-in for crypto as a sector. You can see that these correlations seem to have really weakened into something borderline insignificant. And that is perhaps because crypto really didn't participate in the risk rally starting since mid-October or so. Instead, it stayed low and really only perked up at the beginning of this month, at the beginning of January. That may be because of the weaknesses we've had around FTX and the scandal there, and only recently did it really start to catch that risk-on bid, as a lot of those headlines sort of faded from the front page, or at least there was a bit of acclamation with what was going on there. So that is perhaps these correlations on a 60-day view have weakened somewhat. Nevertheless, Bitcoin and crypto in general is a space where we have tremendous sensitivity to rates and tremendous sensitivity to overall risk appetite. These things are way out on the risk spectrum and yield nothing. So if whatever happens with the Fed here gives us a situation where those things are in motion, this correlation might snap right back in. But what then of the announcement? So if the markets basically have it pinned down, that the Fed is going to come out and say, steady as it goes, we have further to go on inflation, but there's more tightening still in the pipe, so we can start to pace ourselves a bit more here. We don't need to go at massive 75 or even 50 basis points clips anymore. Now we can start to ease our way into a pause. Let's do 25 now, as is widely baked in. Let's maybe do 25 more sometime in March or May. Let's cool our heels from there in June and see how this goes. Markets seem to agree. Fed seems to be of this mindset. This story may be confirmed by tomorrow's announcement as having aged out of speculative interest. There may simply not be anything else to speculate on in the near term. The markets and the Fed may be in agreement. Asset valuations may be fully reflecting of that agreement. What then next? The growth story may be next. And so the markets may go, okay, well, if our focus up to here has been where will the Fed go at the next meeting, or the next handful of meetings? How hard will they go? How long will they keep going at whatever speed? If the end is very clearly cemented as in sight, then the next question might be, well, what's all this going to mean? To what extent is all this a growth risk? To what extent is it a financial stability risk? The last time we had a much more modest tightening, after a much shorter period at low rates, we got the global financial crisis. This time, we have had the longest pause between the end of an easing cycle and the start of a tightening cycle, i.e. the longest period with really bottom of the barrel rates, really in the history of the modern financial system. Those rates also went the lowest they'd ever gone in the history of the modern financial system. We've also had a massive build out in debt, equivalent to the size of global GDP in 2019 in that period of time. The likelihood, it seems to me, that there was malinvestment other than obviously the consternation we've already seen in crypto in that space seems quite high. And that the tightening still in the pipeline is going to trigger some sort of a shaky situation in some of that debt seems highly likely. We'll see how that goes, of course, but if the markets after this meeting say it's time to broaden the lens and focus not on what's the Fed going to do this meeting or next meeting, but rather what does this environment that the Fed has wrought mean overall, the response may be risk aversion. The response may be de-risking. Not because we necessarily have a crisis today, but because the markets may look at the situation and go, growth is weak. Recent data has been coming out weaker than even relatively dismal expectations have suggested. We have a situation where all of the guidance we've received from corporate earnings reports is about as fire and brimstone as it could be. Let's take some risk off the table. There's been a good rally since October. Why are we going to be exposed here? That's a kind of situation which, based on the correlations we've just seen, would be bad for stocks, bad for industrial metals, bad for precious metals, good for the U.S. dollar. Unclear what it would do for energy. That seems to be all its own kind of animal at this stage. And my sense is crypto might be forced back to the party, having kind of wandered outside for a bit. This has been Macro Money. I'm Ilya Spivak, head of Global Macro at tastylive. Thank you very much for joining me. Good luck out there. Godspeed.